Welcome back. This is part 2 of the Smart Money Concepts series. And today I'm going to be talking about one of my favorite concepts when it comes to trading, which is liquidity. So let's dive into the charts right away, guys, and actually show you some great examples of what liquidity looks like, why it happens, how we can use it to really catch sniper entries in the market. So we're going to look at NAS here real quick. And I'm going to look at just a lot of different examples, both for sell opportunities and also for buy opportunities. Now, in the last video, we talked about imbalances, and we're going to continue to explore other concepts. But I want you to understand that these, individual videos or these individual things that we're talking about, such as liquidity, imbalance, etc., by itself are pretty decent. But when you mix them all together, that's what gives you that full comprehension of how price action is created, how everything really, works algorithmically, so that we can have a really, early start of understanding where the market should be heading to next and why. So let's look at NAS 100 here. And I'm going to literally just sort out through a bunch of different points in price. And like I mentioned in the last video, you can use all the concepts that I'm going to be discussing during this smart money series on not just NASDAQ and indices, but you can use this on, gold. You can use this for FX pairs, stocks, literally whatever you like, right? So right away, I can tell that you guys are going to see that liquidity is probably the most important concept out of all of the ones that we're going to be talking about, because it's really what drives the initial movement into a big, trade, right? So let's look at, we're going to start all the way to the left-hand side here on NAS, and we're going to work through example after example after example. So what do we see here in this piece of price action? We see that the market had actually exploded to the upside, made a really big rally here. And then we kind of eventually slowed down and headed into basically like a consolidation phase here, right? Now, we got to keep it in mind, when it comes to trading, this is a big psychological game, right? Whatever you think may happen, especially as a beginner, the opposite is probably going to end up happening, right? Because you have, again, most people are not successful in trading. Most people are not winning. Most people, haven't stuck around long enough to really understand the game. And so whatever you may initially think the market can do based off of just looking at it off the top without understanding deeper concepts, you'd say, hey, well, the market already gave a really big push and now it's slowed down, so we're probably going to drop now, right? And that logic sometimes obviously can work, right? The market at the end of the day can only go in two directions. So it's not a genius if you say, hey, it went up, it's going sideways, we're probably going to come back down now. But this is where having a little bit of patience and understanding through looking at charts for a very long time, that these scenarios that seem like very easy trades to look at, like, oh, this is clearly going to sell off. I mean, look, it's already starting to push down. Those are the moments where we can start to see liquidity come into play. Now, what I want you to understand is that in the markets, you yourself should be using something called a stop loss, right? And the majority of basically all the participants in the market, they're going to have, areas in their, buys or sells in the market where they have to put that stop, right? They have to pull the trigger on exiting that position if things are not going your way. Now, some of you guys may have heard of, stop hunts. Some people call it liquidity raids. Some people will call it fake outs. You can use a lot of different terminology, but this is where we're going to start to dive into what exactly is liquidity. So just to make it very simple, because my goal with this series is not to give you guys these crazy technical terms and all these fancy explanations, right? I don't work on Wall Street. I'm not a market maker, right? I'm just another retail trader that just has, been doing this for half a decade plus now. And for me, essentially what liquidity is going to look like is, where are the stop losses for the masses going to be on the charts? And how can we, knowing that, basically look to have a market that stops everybody out first and then pushes into the true direction that it wants to go, if that makes sense, right? So if we notice in this piece of price action, what do you have? You have the market going sideways for a while, right? These are 30-minute candles. So this was essentially, man, this looks like what? Midnight to about 9. This is like almost about 12 hours, right? 12 hours of just complete sideways movement here. So what's going to happen is there's going to be a lot of stop losses, both above and even below, because there's people that are going to be looking to trade this as a continuation, people that are going to look at, the breakout of the downside to enter positions, right? Now, something important that you guys want to understand is all the different types of orders that you can place into the market. So for example, you guys have, market execution where you're just jumping into trades right away, but then you have your pending orders, right? So if we go on Google, for example, and you look up like, Forex pending orders, right? You'll get like an image like this, right? So you want to familiarize yourself if you're still a little bit newer with what are pending orders, because this is how liquidity kind of starts to come into play. You have buy stops where they basically are going to put you into the trade as soon as price crosses a specific price point and you expect it to keep pushing in that same direction. Same thing with the sell stops. You're, seeing the market go down. Once it hits a certain price, you want it to activate you into a sell to continue that momentum. And then you have the limits, right? Buy limit, sell limit, where you're looking for it to hit a certain price point and actually reverse and turn around, right? So let's, keeping this in mind, start looking back at this piece of price action right here. And so what's going to happen is that, most people are going to be like, hey, we just ran up price very aggressively. Now it's starting to slow down. And now we see it breaking to the downside. We must clearly be in for a big sell to correct this really big push from earlier in the day. All right. Okay, well, that's where the pending orders can start to activate. People may have sell stops set down here, right? Activating them into sells as soon as they start breaking that area of consolidation so that you can end up catching this move to the downside. Again, guys, any strategy in any way that you trade at some point is going to work. But what we're looking for is to understand why the market does what it does so that we can be more consistent and avoid things like fake outs, right? So liquidity, right? Stop loss is going to be sitting below these points very aggressively, right? For people that are buying that support zone, right? Then you have people that are going to have, their pending orders for like a sell stop where they activate into a sell and they may have their stop losses set up here, right? Because they want to catch the sells. All right. So that's how you start building up liquidity. You start knowing where are these stop losses going to be? Where is there money in the markets that can be grabbed if the market can just basically push into those directions? So one way that I really love to look at, liquidity grabs or fake outs or manipulation or whatever phrase you want to give it, I love seeing it in the form of wicks, right? Wicks tell a very big story about what intention the market has to go where, right? So typically, if you guys, have a candle, for example, we're going to draw one out over here. And we're going to do a bearish candle. And then we have a really long wick to the upside. To the downside, Let's make this a little wider. There we go. I'm going to exaggerate this example so you guys can get a real understanding of what I'm looking at here, right? So if we have a very, strong bearish candle that, has a really long wick like this, right? That is a potential sign that we're going to start to, look at this wick as price looking like it was going to make a really strong push to the downside, but ends up closing back above right here, right? Or I should say, so we had the candle open right here. Price comes up, comes down very aggressively, and ends up closing here, right? You want to really familiarize yourself with basics, by the way, guys. If you don't understand the basics of a candle, right? Open, low, high, close. Don't skip steps, right? That's why I highly recommend that you guys, if you don't even understand open, high, low, close, the anatomy of candlesticks, all those, beginner concepts, you need to get either with, some basics information. At the end of the day, I just tell people all the time that you're going to save so much time and money if you just have proper mentorship where you can learn concept by concept the way you're supposed to, right? Right now, guys, we have an amazing promo for akashx, our private mentorship program. You can find the links in the description below, where we have pretty much all pre-recorded content for not just basics, but even all of this smart money stuff that I'm going over for free on this video for you, much more in depth, as well as my Liberty strategy, signals, and so much more. So if you guys want more information, you can DM me at I am Rich Vendiga on all socials. Get in contact with me, get started with the akashx so you can learn the basics. But let's continue, all right? We have this rejection to the downside. That's how I love to see liquidity grabs or liquidity raids or fake outs, right? And we see a really good example of it with this candle right here, all right? Because essentially what we have was price made that initial move to the downside, right? Breaking structure, everybody that was buying basically got stopped out here. Now everybody's going to be chasing these sells, because when you have these really strong aggressive candles like this, people immediately are going to go into panic mode of, FOMO, right? Oh my God, the market's dropping. We got to get in. And notice how as it's making this little pullback and it looks like it's going to make one more drive to the downside to keep this real big sell going, right? What do we get? We get this very nice wick rejection that actually breaks below this little low. So this is how I love to see liquidity, right? We see this low, price comes to take out that low and ends up closing bullish and making this move to the upside afterwards. This is a perfect example of a liquidity grab or a fake out. And like I mentioned in the prior video, notice how we have this imbalance here. If you have not watched the video on imbalance, it's the first one in the series. You guys can click up here and you'll be able to watch that video and put these concepts together. But look how we have the imbalance here, and price also grabs liquidity, right? It takes out that low and ends up rejecting and pushing higher. That is our first example of liquidity. You can see, again, how we had this very long wick to the downside here. And what did that candle do? It ended up grabbing all of the liquidity from this support area. If I go into smaller time frames, like the 15-minute, the 5-minute, we can even get more detail. Now, keep in mind, it's not going to look the same. So as you drop down time frames, things that look like a wick are going to end up looking like actual just full candles, right? So just keep that in mind as well. But again, this is that wick we had in question. So we already saw the liquidity grab here, faking out and then pushing up. And we get the continuation of that play with this really long wick to the downside here, where we grab all of the stop losses below this area of support. And the market will do that over and over. And typically, you guys will see these spikes in liquidity. Whoa. You'll see these spikes in liquidity happen mostly during news. Any high, red impact, high impact red folders that you'll see on forexfactory.com, right? You go on here, you start to see, hey, we have FOMC, hey, we have CPI, PPI. All these red folders are going to usually trigger these type of liquidity grabs, these type of fake outs, all right? So we have two bearish examples there, faking to the downside, rejecting up, faking to the downside, rejecting up. If we want an example of how that looks like to the upside, same thing, right? Everybody sees that we're uptrending, uptrending, uptrending. And what happens here, we have price form a quote unquote resistance, right? There's going to be a lot of stop losses above these equal highs right here. And you see how price comes and grabs that liquidity, and that ends up pushing us to the downside. So one thing I can tell you is that when it comes to liquidity, the easiest way that you can kind of start to spot it is look for areas of support and resistance that are very obvious, right? So for example, if you have price make like a triple top, right? There's going to be a lot of money sitting above that. So price will typically run that liquidity, and then reject to the downside and move down, right? We see that happen exactly right here. Money sitting there in the form of stop losses, liquidity gets grabbed, and we end up pushing to the downside. Not only do you see this example here, but look at it again here. Price goes sideways, price spikes up, grabs that liquidity, and has a big drop. So this is not something that is just a one-off. It will happen over and over and over. If I slide this to the left a little bit, we're going to see price has these equal highs, price runs on that, and then drops, grabbing that liquidity. Right here again, price grabs this high, as well as all these little stop losses above here, and then it drops. So over and over and over, both on the sell side and the buy side, you will see that liquidity, again, is that indicator of that first initial movement that's going to end up pushing price the other way. Same thing here. Price had already been dropping for a while, right? Price slows down. We get that liquidity grab. Look at that beautiful wick to the downside right here, faking out below all these lows, right? Money sitting there gets grabbed by that wick and price shoots up. So over and over and over, you guys will see examples of this. You have all these lows from this move, right? What happens? Price comes, grabs that liquidity, and pushes up. See this area of consolidation here, right? Some resistance, money sitting there. What happens? This wick comes into play and drops price. So this is one thing that it may not stand out to you if you've never heard of liquidity or of fakeouts or whatever you want to call it right before. But the minute that you see this video and that you start to understand, wait a minute, this thing really happens like all the time. Well, because this is exactly how the market creates price action. You see this consolidation, price grabs that liquidity right here and rejects. I can do this literally all day because the market does this on purpose, right? And it's very intentional. You see the wicks pop up and then drop price. So all in all, guys, what you want to do is understand the mindset first of if it's too obvious, the market's probably going to do the other thing, right? Like market's going up and up and up. We're breaking structure over here. Well, that may be a time to just give it one or two more candles. You're going to see that rejection that ends up leading to a big, sell-off. And it'll do this again over and over and over. All right. And timing is a big part of it, guys. Again, for me, trading NASDAQ around, the New York Open after 9:30, right? And looking at any high impact news is going to be the cheat code of understanding when to look for this stuff, right? We want to look for that during New York session and, time that correctly. But again, I can just go example after example, right? We see that big push up and then we sell off. See that fake to the downside and we push up. See that fake to the upside right here and we sell off. Fake to the downside and push up. So go on your charts, guys. Look for any, wicks that kind of push with the trend and then reverse. And that's going to be your, beginning understanding of spotting these fake outs, understanding how liquidity works in the market. And again, if you start to pair this with the other concepts such as imbalance from video number 1 and the rest of the videos that you're going to see during the rest of this series, you'll start to really get a good grasp of, directional bias, why the market is moving where it's moving, how to time things and how to really get, very precise entries. Once you start understanding where the stop losses are, that's where you can, really look at jumping into the trade at its peak high or peak low and catch basically from start to finish the entire big move. And that can create some really strong risk to reward opportunities and just little to no drawdown. I think that's my favorite thing that I'll conclude this video with, guys, is if we can find scenarios where as soon as we enter the market, we're already pushing into profit and we're able to move our stops to entry and just create a risk-free trade scenario as quickly as possible and not have to sit and watch your screen in red for an extended period of time before your trade goes your way, or if you hit stop loss, right? I just feel like that's the greatest thing as a trader, is just to be able to, again, hey, we have this area of resistance. We're going to sell as soon as we spike that resistance. And as soon as you're in that trade, you're just in profit and able to get out, right? Easier said than done. Obviously, even understanding liquidity and all these concepts, guys, you're still going to lose trades. But again, the main thing is understanding why the market does what it does and how to anticipate things like reversals when you really get a grasp on liquidity. So hope this video helped you guys. Please make sure to like, comment, subscribe, and share this channel. We're closing in on 400 subs very, very soon. Part 3 of the Smart Money concept series coming out very shortly as well. So catch up on video 1. This is video number 2. And with that said, appreciate y'all. Hope you have an amazing rest of your day, and let's run it up.